Hi, I'm here with Don Ernst, a farmer's insurance agent from Leawood, Kansas. Hi, Don.
Hello, Michelle.
Don's agreed to talk with us today about juvenile life insurance.
Okay.
This is kind of a sensitive subject. This kind of made me feel weird to talk about it. Is that unusual?
No, a lot of people feel the same way, and I think it's important to establish coverage on a brand new baby. They have to be 15 days old to be able to insure them. But a lot of people feel the same way. I don't know any parent that if something happened to their child, they want $100,000. I mean,
Right.
that's not going to make anybody feel better about anything. But what it does do is it establishes coverage for that person that they'll have the rest of their life and at a very low rate. So if you took a policy out on a 1-year-old $100,000 policy at $15 or $18 a month, it'll stay that rate forever. Now, the important part about that again is I don't know any parent that wants to would feel good about receiving a death benefit. But what you've done is you've established the coverage, because a lot of people get to the age of 18 or 22 and they find out they're uninsurable, and so they go to buy their own policy for the first time, and they've had childhood leukemia, diabetes, cancer, they've already got high blood pressure. They may have a height and weight issue at a young age that could cause them an issue of purchasing insurance.
Okay, so that makes a difference. Okay, so it's not so much for your brand new baby is thinking something terrible is going to happen, but it's for them as they get older to kind of lock in something that might go away.
Right, you've established
Okay.
coverage that they can keep forever. Mm-hmm.
Okay, and so is there a certain age group that it fits? Can you do it right away as soon as they're born, or?
15 days is how
Okay.
long we have to wait, and that's just that is a critical time of a baby's life, that first 15 days. So we get past that, everything's established, everything's fine, everybody's home, everybody's doing good, there aren't any current health issues, and then that's a real simple application, and it issues very quickly.
Okay, and in our other video we talk about life insurance and the difference between term and whole life. What kind of a policy would this fit in?
Generally, we do the universal or the permanent policy on children. Well, the terms aren't even available. It's going to be the permanent policy, because you can get a lot of coverage and the premiums are next to nothing anyway, and so it'll be a very low premium forever for them.
So then if the grandparents buy it or the parents buy it, does it matter who buys it?
No, they have to have an insurable interest
Okay.
to be the owner of a life insurance policy on an insured. But yeah, grandparents or aunts, uncles,
Okay.
mom, dad. Yeah.
So it could even be a gift, maybe, and then
Right.
and then it. I presume it transfers over to the child once they're grown up, or can it?
The parent could retain ownership of the policy forever,
Okay.
or what happens a lot of times when kids get out on their own, they've graduated from college and they're establishing their own families at that time, and they have this $100,000 policy, and a lot of times the parent will assign ownership of the policy over to that person at the time.
Okay, great, and then they
Yeah.
can continue on with it.
Right. Mhm.
Can they then make it bigger?
If you want to increase the coverage, you may have to show insurability at the time.
Okay.
But they do that. But then they become the owner and the payer of the policy. So the owner elects who the beneficiaries are going to be,
Okay.
how much they want. Again, they can. It's a flexible policy. So if they wanted to start paying more money into it, because it does grow tax deferred, that's an advantage that they'd be able to increase the premium.
And then, as with other whole policies, could they borrow against it if they needed it?
Yeah. Well, what some people will do is they'll work all their lives. They build up cash value in the policies or other assets that they have, and maybe they want to buy a place down at the lake.
Oh.
And so sometimes it's cheaper to go ahead and borrow the cash value out of a life insurance policy than it would be to take a loan from a bank.
Great.
Mhm.
Okay, so it gives them some flexibility.
Right.
Okay, great. And then I guess for that matter, if they kept it all the way till they retired, they could take the cash out then.
Yeah, and that money has grown tax deferred, and so there hasn't been any taxes paid on that. And that's one of the advantages of doing your investments within a whole life policy, because you look at a cost basis. How much did you pay in as opposed to what you're cashing out? So if you, say for instance, if you bought a term policy separately from your investments, your investment just has that for the cost basis. So when you cash it out, that's your only cost basis. Whereas if you do it in a universal policy, the insurance and the cash payment part of it was all the cost basis. So you have a bigger cost basis to take out of that money, so it reduces your tax.
Okay, great. Okay, thank you very much, Don.
Yeah, you bet, Michelle.